Okay, let's take a look at the main results. Looks like they have those presented in Exhibit 4. So let's go down to Exhibit 4 and see how things turned out. Okay, so they're going to note the returns for the value, the momentum, and the combination strategies and the excess returns over the 86 to 2007 period. We see here the different sections. We've got the 1 month momentum, 12-1 momentum, the valuation strategy, and then the combination of both the value and the momentum piece, the one that was 25%, 25%, 50%. And we also see that we have the returns for each of the different quartiles. We remember there are 3 asset classes in each of the quartiles for a total of 12. And first thing we notice here is that the returns and Sharpe ratios of the top quartile, which is Q1, are significantly higher than the bottom quartiles, Q4. And also the Q2 and Q3 quartiles, the ones in the middle, are somewhat monotonic, increasing from the worst to the top quartile. And this happens pretty much for each of the different strategies, including the combination strategy. And in fact, it looks like the combination strategy had the highest Sharpe ratio, which is basically the mean return divided by the standard deviation, to give us kind of a risk-adjusted ranking. And so also here on the farthest corner, we have the difference between the first quartile and the fourth quartile returns. With the 1 month momentum, the top quartile exceeded the last quartile by about 7%, 8% on the 12-1 strategy, 8% on the valuation strategy, and 12% on the combined strategy. Also, and the information ratio as well is fairly higher, especially on the combination strategy. And the information ratio is basically the alpha divided by the standard deviation of that alpha. And that's supposed to be a good gauge of the risk-adjusted active returns of different strategies. And we see here it's very, very high. Also, notably, the T statistic is extremely high. So if we were doing a statistical regression of this, we would find, based on how high this T statistic is, that it's almost a remote possibility that this outperformance is 0%. So we can find that this outperformance of 12% is very statistically significant. So given these results, we could see that the strategy that they're using works for all the different variables that they're using. For instance, the 1 month, the 12-1, the valuation strategy, but the combined strategy of 25%, 25%, 50% is significantly outperforms them alone. So let's go back up to some more of the discussion. So here they're going to discuss a little bit about how the different strategies correlate. For instance, the momentum strategies, that was the 1 month, and the 12-1 strategies have a correlation of 0.3. So the returns of those strategies are positively related, but the momentum strategies are correlated with the valuation strategies on a negative 0.1 to negative 0.3. So the momentum strategies are negatively correlated with the returns of those strategies are negatively correlated with the returns of the valuation strategy, and that's somewhat why the combined strategy works so well is because when the momentum is doing well, the valuation doesn't do as well. But when the valuation is doing well, then the momentum doesn't do as well. And so that diversification creates a good risk-adjusted return. And so that's why they made about half of the portfolio be the momentum strategies and half the portfolio be the valuation strategy whenever they were doing the combined strategy. That way the losses are canceled by the gains of the other, since they're negatively correlated. And so it looks like Exhibit 5 is going to show us the cumulative returns for both the combined and the individual strategies over time. So let's see how that turns out down in Exhibit 5. So here we have a chart of the different quartiles, the different strategies. So this one would be the 1 month momentum strategy. This is 12-1, the valuation strategy, and then the combined strategy. And we can see certainly the combined strategy is the one that outperforms over time. And actually, let's see, so all of the valuation 12-1 or 1 month end up being about the same return over time, which is about maybe 150% over the number of years from 1986 to 2007. But the combined strategy is 250%. So I suppose over this time, someone employing the combined strategy would have about 67% more money at the end of this than if they had used any of the strategies individually. Okay, so let's go back to some more of the discussion. And so given the great results for the combined strategy, the authors are going to see if perhaps the returns of the strategies could be explained by structural biases towards certain asset classes. And so they give an example of a naive portfolio. For instance, if you go long equities and short cash, you're basically just earning the equity risk premium there. The return of the equities minus the risk-free rate. And so their concern is that the quartile portfolios might have structurally different exposures to risk premiums that are offered by the various asset classes. Now, this has been emphasized by prior researchers as well. So for the combined strategy, they want to look at the frequency that each of the asset classes is selected for each of the quartile portfolios to see if there's any bias. It looks like Exhibit 6 is going to show us how that turned out. So let's go down to Exhibit 6. And so here we have all of the different asset classes as well as which quartile they end up being in. It shows a percentage of which quartile. So we notice immediately that the U.S. real estate equity ends up being the most frequently utilized asset class in the first quartile, very shortly followed by U.S. mid-cap equity. And the one that ends up being most frequent in the last quartile is UK equity. So it seems the strategy has been favoring U.S. real estate and as being a top contender for the portfolio. And then the UK equity has been unfavorable to be included in the top portfolios. Also, interestingly, it looks like U.S. Treasuries are very rarely included in the top quartile, and U.S. mid-cap equities are very rarely included in the Q4 quartile. So we do notice that each of these percentages is not really too big or too small. I think this is pretty small and this is pretty small, but generally across the asset classes, we've got somewhat of an evenly dispersed weighting in the quartiles. So the authors argue that that may be evidence for that one asset class is not particularly favored over another from a structural standpoint. So let's go back up to the discussion. Okay, so it looks like in Exhibit 7, they're going to adjust the combined strategy with the loadings for the classic CAPM market factor. That would be the market beta. They're also going to do the Fama-French size and value factors, as well as the Carhart momentum factor. So it looks like they'll do a regression over the four factor model. And so by adjusting by these factors, they're going in search to figure out if these momentum and valuation returns are a unique anomaly, or if in fact they're just explained by the already well-known factors such as the market factor and the size and value growth or momentum that other researchers have found to explain certain returns. So let's go down to Exhibit 7 and see how their regressions turned out. Okay, so here we have the results of the regressions. Let's take a look. First, with the regression, they'll have an alpha figure and then the market beta, small minus big, which would explain the size of the companies, high minus low, which would explain whether the returns are explained by value or growth characteristics, and also the UMD, which is up minus down, and that would explain momentum factors. So, and they've got these split into the normal CAPM model, which would just include the market beta. They have the Fama-French three-factor model, which has these three factors, and then Carhart later came up with the fourth factor, the UMD, adding a momentum factor there. So we have here the 1 month strategy, the 12-1 strategy, and the valuation strategy. We also have the combination strategy down here. I'm assuming these asterisks mean that the T statistic here is significant. So we'll look at these individually. The first thing we see, we'll look at the CAPM market factor. It looks like the market beta really doesn't explain any of the returns for the 1 month momentum strategy. It's somewhat positively related in the 12-month strategy and actually negative related in the valuation strategy. So when the market return increases, the valuation strategy's return decreases, which is interesting to see. T statistic here is significant as well, so we can maybe conclude it's highly unlikely that this is actually zero. But we do see that most of the return is left unexplained by an alpha figure, which are all very statistically significant as well. And so we get somewhat of the same effect with Fama-French three-factor model on these with the 1 month momentum strategy. It looks like size of the asset classes somewhat explain the returns, but it's mostly the alpha. With the 12-1 strategy, the market return somewhat explains the return of the strategy, but still somewhat mostly the alpha figure. And with the valuation strategy, actually it looks like it does a little bit better job of explaining the returns with actually the small minus big and the value growth factors somewhat explaining some of the return, but it's very much of the return is still explained by an alpha. And still the valuation strategies returns are negatively related to the market returns. So as the market goes up, the return of the market goes up, then the valuation strategies returns go down, but not by a whole lot. And so looking at the Carhart four-factor model, then still kind of the same result of the other models that we've seen in the 1 month, where we have the size of the companies is somewhat what explains the return, but mostly still an alpha. For the 12-1 strategy, it looks like the market return explains a little bit of what the returns of the 12-1 strategy will result in, but actually most of the 12-1 strategy's returns are explained by the UMD variable, which would be the momentum variable. And if I remember correctly, the papers written about the UMD variable would be the top decile of past returns minus the bottom decile of past returns, and the difference of those two would be that variable. And so it would be the returns of the past winners minus the past losers. So if this coefficient here is positive, then the returns of this 12-1 momentum strategy would increase as the returns of the past winners minus past losers increases. And so that would make sense with this 12-1 strategy for why is such a significant number. Although I do believe the UMD strategy typically uses a past 6-month formation period, whereas here I suppose we're using a 12-month formation period. And interestingly, the valuation strategies returns are negatively related to the UMD strategies returns, and that would make sense because UMD strategy typically would choose growth companies over value companies, and the valuation strategy obviously chooses valuation companies, and that's the reason why the combined strategy does so well, is because UMD related to the valuation strategy are somewhat negatively related. It looks like the other variables somewhat are related, but not in a large way. Actually, most of the return is explained by an alpha or left unexplained. So now we have kind of a handle on each of these individually. Let's take a look at the combined strategy. And so we see here that from all of the models in the combined strategy, the alpha is the most significant piece for explaining the returns of a very high T statistics. And so it's interesting when you combine all of these together, then each of the variables explain less of the returns. And it looks like the size and the value growth factors explain a little bit of the returns, but the alpha is certainly the biggest piece of those, and momentum doesn't explain any of it. So since this t statistic is so low, we could say that we're almost positive that this coefficient is 0. So it's almost like by combining the momentum and the valuation strategies together, it mitigates the effects of all the factors in the portfolio and leaves it all as alpha